Yeah. Okay. We can resume from where we left off. Just a minute. Just a minute. Capital markets and investment strategies, first deck. Okay. Okay. Let me just get my.
Recording in progress.
Okay. I hope you can hear me. Okay, so let's continue. So, as we were, let me just get the presentation up. No, it's not that. Okay. Let me just present real quick. Share screen. And okay. Yeah, so we had looked about bonds, the different types of, we had even tried to do a bond calculation for a coupon rated bond and a zero rated or a zero coupon bond. We did a sample calculation and saw how, for example, the bond price can be calculated. The bond price meaning the least price that you as an investor should accept. So, for example, a 1,000 Kenya shilling rated or priced bond. We also even saw that we even saw even from the treasury and even other financial websites sites how we can even do bond calculation. For example, we saw the. Let me just get something real quick. I think I'm joining with two devices, and I think it's making my. Mm, no, yes. Okay. So let me just get the presentation up again. Leave. Let me leave with one. Okay. Okay. Document. It was under. Is it this one? Yes. Next page. Okay, we were under bond calculation. Yeah, right here. Yes. Okay, so today I wanted us now to proceed, and now I wanted us to proceed with the yield curves and interest rate dynamics. The yield curve is basically a graph that basically tracks the performance of a bond or the yield of a bond. Okay, the interest rates that is due to a bond, for example, according to different or as per different maturity periods and different maturities. Okay. And why would an investor, for example, in capital markets, both in secondary and primary markets, be interested in the yield curve of a bond? Okay. An investor will basically be able to track the performance of a bond in terms of its yield over a period of time. For example, a 10-year bond or a bond that matures in 10 years, you can be able to track its yield according to just a minute. You can be able to track its yield or its performance over the period of its life, and then from that you can be able to even now tailor your investments or your portfolio according to the bond performance over the years over the life of its maturity. Okay, so we have different types of yield curves. Okay, we have a bond that is increasing, okay, that its yield increases, a bond that its yield is constant, and a bond that its yield decreases. Okay, so for example, a bond whose yield or yield curve in this case will be steeping. For example, it will indicate, okay, when it will indicate that the bond that the yield represents will represent or will give higher yields as the maturity progresses, which is the normal case is in any economy. In any economy, the bond price or the bond yield should always be here, especially if it's a longer maturing bond. Okay, but there could be also some bonds that could be declining or receding. Okay, that is especially if the economy is in recession. Okay. So, for example, we can even look at some of the bond, for example, the treasury bond in Kenya. If we can look at its yield, I mean that's an easily available data. We can look at for example, the yield of the treasury, the Kenya treasury bond, and then see whether its yield has been declining, okay, or its yield has been rising. Okay, and then from even that, then we can even now do a scenario analysis or a stress test to see, for example, what if the coupon rate on the Kenya treasury bond increases, and then what will happen to the yield curve? So as an investor, that will be of interest to you. Okay, you'll be able to see what if the coupon rate increases to this much? Will the yield curve remain the same, or will the yield curve, for example, start to be inverted? Okay, therefore, as we have seen, some yield curves may invert, okay, may increase, and some may be constant over the years of maturity of the bond itself. Okay, so the normal yield curve is usually a one that increases. Okay, all right, especially since the yield increases or as the maturity progresses, because the economy grows. I mean, that's very much self-explanatory. Okay, and as opposed to one, when during recession the yield curve of the bond will decrease, for example, or will be inverted. Okay, and as opposed also to one whose yield remains constant over the life of the maturity of the bond itself. So we have talked about three types. So as as practice, you can even look at even the Kenyan Treasury bond and see its performance or its yield over the years, for example, or even any other, or even the US Treasury bond. You can even look. I will send you notes with a direct link to where the you can. I already have them. For example, if you go to copy link, if you go to no, sorry, resource center, copy link. Resource center, for example, centralbankkenya.go.ke, and then go to bills, bonds, and then / treasury bills. You'll be able to, even Bloomberg. If you go to Bloomberg, I'll attach to you the link. Open link in new tab. Bloomberg.com, and then go to markets, and then go to rates and bonds, and then go to government bonds. Then you'll be able to see, for example, the different even the Kenyan Treasury bond performance and yield over the period of maturity of the bond itself. Okay, you can even be able to see, for example, the different types of bonds. Or for example, if it's a 3-year bond, a 5-year bond, or a 10-year bond, how does that compare? Okay, how does that compare, or how does it affect the shape of, for example, or the shape of the yield cap of that bond? Okay, let's continue. And then we have also talked about scenario analysis, okay, therefore, as an investor, you predict or you forecast or simulate a scenario where the interest or the coupon rate of that bond increases, especially the interest rates on and even the bond price increases, and therefore the yield of that bond will also be different, or will either increase, remain flat, or decrease. Okay, we've said that as the bond price decreases, then therefore the lower rates become less attractive when the yields increase, because obviously buyers who are interested in investing in such bonds will be motivated to buy such bonds. Okay, so for example, when an interest rate increases on the bond coupon, okay, when the interest rate is high, maybe by the treasury, what will happen? For example, obviously, even if we substitute directly in the formula, the price of the bond will drop, obviously, when the rate is hiked or increases. Therefore, the bond will be less valuable. Okay, and therefore you even find, especially for investors who have, let's say they have a 10-year bond, a 30-year bond, okay, they will be more affected since the interest rates will be greater due to the higher duration. So if you hold a longer term bond and there are interest rate fluctuations, then even the overall bond price and the overall yield to you as an investor will be greatly affected. Okay, so having said that, I wanted us to look at some 3 concepts relating to bonds. Okay, how to measure, for example, the bond duration, how to measure the convexity, and also the credit ratings. As I told you, for example, especially corporate bonds, it is very, very much dependent on, for example, on the credit rating of the company or the corporate that is issuing that corporate bond. Okay, so we'll be looking at that. But first, I wanted to look at the bond duration. In terms of bond duration, there are two main concepts and a bond duration measurement. That is the modified duration and the maculated duration. I hope you already know how to calculate each, but just for learning purposes and also comprehension purposes, I'll also just give an example, a solved example, and then we see how such a bond duration in terms of both durations calculations, that is the mod D, modified duration, and the MACD, the maculated duration. They are called MACD and mod D commonly. Okay, so I hope we can, I hope you are able to see where we are. Yield curves. Yeah, so we just talked about yield curves and the interest rate dynamics. Interest rate dynamics is where I've said we can do a scenario analysis or a stress test, okay, and simulate a scenario where the interest rate hikes and they bounce. And then we have also seen how that will affect not only the bond price, the bond yield, even the interest rates, the bond value, but also what will happen to the investors, the individual investors of that bond itself. So now we are under 3. That is the third section of that module, that is measuring bond performance, duration, convexity, and credit ratings. So we have started with duration. We have told you there are two main concepts of the bond duration calculation. That is the macro duration, which basically it uses you weight the time of the cash flows, okay? You weight the cash flows according to, as per the time. I don't know if you can understand. You weight each individual cash flows or the present value of the cash flows of the bond from the bond, okay, according to, as per the time. Okay, so for example, let's say, let me just present my screen. I hope you'll be able to see, so that we just do similarly as we did the other day. Notes. I'll be able even to find the notes for the other day so that we continue. Okay, here. I hope you are able to see my screen. Just go to notes. You should be able to see my screen. Okay, so let's say, so we are under MACD, bond duration calculation. Okay, so I wanted us just to do, I have told you what MACD, basically the bond duration according to the MACD formula is basically, you just time weight the present value of the cash flows from the bond. Okay, so let's say, just an example, okay, we have a bond, okay, let's say it's a 5-year bond, 5-year bond, and let's say coupon rate is just like last times, 3%. And the YTM, let's say, is 2%. Okay, so what will first of all, let's also say the coupon rate of the bond. The bond is 1,000. Okay, the face value, F is 1,000. Okay, so now first of all, we'll need to calculate the cash flows. Obviously, cash flows is the coupon rate times the face value. That's 3% of 1,000, which is 30 over 30, right? 30 bob. Okay, 30 Kenya shillings. Okay, so that's those are the cash flows. Okay, so now what's the formula? The formula for getting cash flows, obviously, as I told you, we discount the cash flows according to time. Discounting and weighting is the same. Okay, so it's all the cash flows. Okay, so basically, even as I said that at the time, is equal to 1 divided by 1 plus the YTM, rest per the year. No, this is not. This is cash flows. So the cash flows is 30 divided by 1 plus, what am I typing? Yes. Raised power the n, raised power n. Okay, that's basically it. So in this case, so it's a 30-year bond. So for example, the first year it will be, so which is as I said, the CF, the cash flow, that is 30, 30 divided by 1 plus, what was the YTM2, right? 1 plus 2%, that is 0.02, right? So 1 plus, so it's 1.02, right? Raised power 1 for the first year. So PV1, so that's the first present value, that's the first cash flow. Okay, we are time weighting the cash flows. Okay, so PV1 or cash flow 1, CF1 is 30 divided by 102 raised to power 1. Okay, that one will get as, hope you have your calculator ready. That comes to 29.41. 29.41. What am I typing? 29.41. Okay. Similarly, cash flow 2. So now all we do, instead of raising by 1, we raised by the second year. So by 2. By the third year, 3. By the fourth year, 4. By the fifth year, no, the fifth year. So now it was a 5-year bond. Okay, 5-year bond. Okay, 5-year bond. So now the fifth year is the one where we'll receive now the principal. So we'll receive the principal plus the cash flow for that fifth year. Okay, so it will be 1,000 plus 30. So 1030 divided by 1 plus just 1.02, now raised to power 5. Okay. Okay, so should I just do it or okay, let's just so CF2, as I said, and then so now, okay, 30. Similarly, just to divide divided by 1.02, 02 raised to power 2, and that will come to, say, just remove the 1 and put 2, that comes to 57.68. 57.68. Okay, cash flow 3 equals 30 1.02 raised to power 3. That will come to, just remove the 2, I put 3, comes to 84 bob point 81 Kenya shillings. Cash flow 4 similarly is 30 bob divided by 1.02 raised to power 4. That comes to, just remove 110.879, so 88. Okay, and then now, so as I just said, the fifth year is where, since it's a 5-year bond that matures in 5 years, so it's the fifth year that will also receive also our principal. So now it will be the principal plus the coupon for that year. So 1,000 plus the 30, the normal 30. So that comes to 1030. Also still divided by 1.02 raised to power 5. That comes to, just a minute. There is a process that I just bypassed, but I'll tell you, it's not. That comes to 4708.245. So 25. Okay, 4708.25. Yes. So now to get the mark D, it will be the sum of the time weighted present values divided by the sum of the present values. Basically, First of all, we'll need to multiply these 29.41. These first of all, these ones have also been multiplying by the time. Okay, you need to also multiply by the time. If it's the first year, you multiply the present value that has been discounted by the time. For example, if it's the third year, you multiply the present value that has been discounted at year 3, that is 1.02 raised to power 3 times also 3. Okay, that's why I have been getting that's why I told you just to save time, I've been bypassing a process. But basically, okay, I can even just, for example, the first year is 30 divided by 1.02 is not 29 points, it's 29.41. So and then you multiply this times 1 because it's the first year, you get now still 29.41. But for the second year, if you divide 30 divided by 1.02 raised to power 2, it's not 57, it's 28.84. And then you multiply this by it's the second year, so 2. It's the 2 year, so 2, which will now get us this. Okay, this one, if you multiply 30 divided by it comes to 28. Around 28.27 came to 20. And then so now you also multiply by 3. Okay, which will now get you 84. Similarly, okay, it will get you 20, also 28 or 20, no, exact 27.72. Also multiply by the 4. Fourth year, 4 by 4, which will now get you 110. Similarly, the 1030 times rest power, it comes to 941. 941.65, which you times by the 5, the fifth year, which now gets you 4708. Therefore, so now to get MACD, it will be the sum of the present values times time, okay? The 4708 plus 1 plus 84 plus 57 plus 29 divide by the 29, 28, 28, 27, 941. Okay? I hope you understand. So basically, you are given a bond. You first determine the cash flows of that bond by obviously or compounding the coupon rate by the face value of that bond. The face value was 1,000. The bond was a 3% bond for 5 years. So 3% of 1,000 is 30 bob. So and then you discount each cash flow for the 5 years as per the time or according to the time. If it's the first year, you discount by 1 using the YTM. Okay, 1 plus the YTM. Okay, if the second year, discount the 30 as year 2, still using the YTM. Okay, same way. So MACD is sum of the present value, because discounting is basically bringing back cash flows. Okay, since it's a bond that we are supposed to receive in the future, so to discount is to bring them back, or that's why we divide. So present, we bring them back to the present. Okay, we bring them back to the present. Okay, so sum of the present value times the time. You see how we have been multiplying by time. Okay, so multiply by 1, multiply by 2, multiply by 3 times time times time. All these divide by now the sum of PV. The PV now the individual ones we have been discounting. Okay. Therefore, MACD is equal. So now we first add 29.41 plus 57.68 plus 84.81 plus 110.88 plus 4708.25. That will bring us to 4990.94. I hope my calculations are all okay, but obviously it's not important. You get the point. You can do them at your own time, but I hope my calculator is not failing me. Okay, so divide by, so now we add the discounted present values cash flows itself. So 29.41 plus 28.84 plus 28.27 plus 27.72 plus 941.65. That comes to 1055.89. And then we divide that to get our MACD. MACD comes to 4.7. So 4.7. So 4.7, what is this? It's a duration, MACD, macula duration. So this one is in years because it was first year. So this one is in years. We are discounting a 5-year bond in each year. So 4.7 years. So that's the MACD. Okay. I don't know if you can get that. If you have any questions, I can be able to answer you. Okay. And I don't know if you know why I started with MACD. Mod D is now very, very easy. Mod D is now that we just divide by that, the MACD, divided by 1 plus the YTM. Okay, so in this case, the mod D will be the MACD divided by 1 plus 1, the 1.02 that we've been, 1 plus YTM. Therefore, mod D is MACD, we got it 4.7 divided by 1.02. Therefore, mod D, the modified duration, is basically like discounting the MACD. Okay, then therefore, the mod D comes to 4.7 divided by 1.02, 4.64. This is also still linear. So that's the mod D. Okay. I hope that's okay. So that's how we can now calculate the duration of a bond in terms of those two duration measurements. Okay, MACD, we basically just discount the cash flows as per the year or according to the year. We discount as per the year. Okay, if the first year we discount risk power 1, second year risk power 2, similarly, and then we add, and then so now since we are calculating my D, we also compound by the factor of the each year. Okay, because the first year we compound the present value that we have now discounted, we compound it by the factor of that year. Okay, if it's the second year, by 2. If it's the third year, by 3. And so on and so forth. Okay, so that's all about I hope you know measuring bond duration. That was on MACD. Okay, let's now look at credit rating. I think we've talked about a lot. Okay, we said that when corporates issue corporate bonds, it's risky since companies carry risk of credit risk, default risk, all the types of risk that they carry. But then there is also a default risk that they carry due to their credit rating. Okay, so that's even why such bonds are also dependent on the credit rating of the value of such bonds are depending on the credit rating of the company that is issuing it. Okay, for example, if a country, or let's say a country is rated, there are different credit ratings, for example, A, AAA, B, BBB, things like that. Okay, just basically just how, for example, an individual can be rated, for example, on the CRB, like C1, B1, things like that. Okay, So you find that when you are, for example, when you are rated at A, that's the best rating, and therefore your bond can attract investors. Since investors perceive you to be having a good credit rating, therefore you cannot default. Chances of you defaulting on paying them their bond, okay, or their bond yield, okay, are minimal. As opposed to a company that has a poor credit rating, their bond will likely not fetch as much. Find that most of the, for example, most of these S&P 500 companies, these Taiwan, what are they called? These big five companies, most of them are rated AAA. They are the best ratings, for example, credit ratings. Okay, especially that also applies to, especially if an investor is looking at is interested in the credit rating. It's investors that are interested in the credit rating of the company whose bond they are buying, that comes in very, very handy. Okay. Let's also look at now the last concept. There were three concepts under measuring bond performance. Okay. It's the duration over the years. Okay. We have seen MACD and MOD credit rating in terms of, for example, the rating of the company that is issuing the bond. Also, let's look at convexity. Convexity basically it quantifies for example, the yield of the bond, or the bond yield, the curve. I don't know if I'm explaining this right. Okay. You see the yield curve of the bond. Okay. So now it kind of quantifies that yield curve. Okay. So such that should the bond prices change along the yield curve, or the interest rates change, their interest rate changes, and then therefore that much it changes by. So that's what convexity measure. Convexity measures basically the change of the yield curve of a bond, okay, in terms of its yield and also in terms of its price, if there are adjustments of if interest rate changes, or things like the bond price changes, or interest rate or coupon rate of the bond changes. Okay, that's basically it. So, for example, let's say there is a 1% change. Okay, it's basically, you see how we were doing the duration, okay, the MACD and the MOD. So now you can do a stress test or a scenario analysis where you simulate a scenario where the interest rate, the coupon rate, or the YTM changes from 3 to 4. Okay, and then so now you see how that will in turn, in fact, affect or influence a change on the yield curve of the bond itself. Okay, so you find that when, for example, there is a marginal, or there is a significant increase or change in the interest rate or coupon rate, and then therefore the change in the convexity or the shape, okay, or the nature of the yield curve of that bond will also be huge. Okay, therefore that is especially of significance to investors who are interested in the long-term yield and the yield curve of the bonds they are interested in purchasing. We gave the formula for calculating even the MOD. So now the MOD and the MACD. So now you can do a scenario analysis where, for example, the coupon rate changes, and then you see how much it will affect the yield curve of that bond. You can just plot it on a chart or on a graph, and then you'll see that change, the much change it will have, and then therefore that can now be the convexity. You can even now see even how it will even affect the MOD and the MACD. Okay, when for example we just used the coupon rate to be 3, YTM to be 2, what if that changes? What will now be the new MACD and the new MOD? Okay, and even what will be the new bond price? Okay. Okay. So I hope that so far we have you have gotten. Don't know if you have any questions up to that far. Just a minute. Mhm. So we have talked about the bond duration, the convexity. We have also talked about the when how to calculate the two different types of duration. So we talked about credit ratings of especially corporate bonds, even countries of credit ratings. Even Kenya, I don't know the credit rating I saw recently. I read that the credit rating of Kenya fell, especially when a country defaults on it. For example, Eurobond that they issue or payments. Their credit rating is one that they fall. Just a minute. I hope we had also talked about managing interest rate in volatile markets. Okay, you remember where we talk about volatile markets, especially markets that are just developing. Okay. So now let's move to module 5. That's portfolio management strategies. And this is what we've been talking about a lot. I mean, as I just told you, these all will be doing a lot of recap and also a lot of borrowing from what we've learned before in our past lessons. Okay. So portfolio management strategies. There are two main strategies for managing a portfolio, for example. Okay. You can use the modern portfolio management strategy. Basically, that it emphasizes or it says that, for example, an investor needs to use a portfolio management strategy that diversifies their investments to maximize their returns at the lowest possible risks, for example. Diversify in order to, for example, maximize your returns while also minimizing your risk, okay? Basically, it says that an investor should be able to construct a portfolio management strategy that makes sure that the assets, okay, or the portfolio of assets and liabilities that they have, okay, or that they hold, will give them the maximum returns for the for a very little risk that they take, okay. And we all know what risk is, for example, and how to measure risk. For example, the value at risk. Basically, we measure the SD, the standard deviation, or the volatility of that particular portfolio or asset uh, that they are investing in. Okay, and then so now we can even when you plot or when you track the returns and the against the risk, and then you will come at an efficient frontier. An efficient frontier is basically a line that represents, for example, how much return, okay, or how much return will be for a given level of risk that an investor takes, okay. So basically, you plot the risk against the return, and then for each level of risk, what's the maximum, what's the most returns that the investor will be able to reap, okay. And so now, how do you construct a good portfolio management strategy, or what's the best portfolio management strategy, okay? Especially considering the modern portfolio theory that I've told you is aiming at construct the best possible portfolio that will give you the maximum return at a particular level of risk that you take, okay? So let's say you can invest in two assets, okay? Let's say you wanted to invest in the shares of Safaricom, and you also wanted to invest in the shares of Kenya Power, okay? And let's say the rate of return on the shares of Safaricom are that you can also easily calculate. Let's say it's 10%, okay? But the rate of return of Kenya Power is, let's say, 12%, okay? And let's say the volatility, when you calculate the volatility for the rate of return on Safaricom, let's say it's 15%, okay? While since the rate of return is higher, therefore for Kenya Power, the SD, the standard deviation or volatility will also be higher. Let's say that one was 15, let's say this is 20, okay? Therefore, what's the correlation coefficient? Correlation coefficient is basically what relates the two. For example, the returns of those two assets. Let's say it's 0.5. The correlation coefficient that's usually given the relationship between the one portfolio and another. Okay, let's say they are related by the correlation coefficient of 0.5. Okay, therefore, to calculate now the expected return, you first calculate the expected return from each portfolio. Okay, it's basically you weight you weight for Safaricom times the expected return for the first year, for the second year, and so on and so forth. Okay. So you basically you take the correlation coefficients. That's why it was important. Okay. I'll get you some data, and then and then show you even, for example, how to calculate that. Don't worry. We'll see about it in more details in lessons to come. So I think I can even let's say we can even go back to the notes, and I'll try to also just give you just a quick calculation of what I'm trying to say. For example, this is just an example. Let's say we have, as I've said, we have two assets, okay, or two portfolio. Let's say you have two portfolios of investing in the shares of Safaricom and the Kenya Power. Okay. So this is the portfolio. How will you construct a portfolio management strategy? Okay. So let's say, for example, you have Safaricom, whose, let's say, the rate of return R, okay, or expected return. Now ER, expected return, because now return is expected return. Let's say 10%. We say 10%, right? Okay, Kenya Power, KPLC, the rate of return on their stock or investing in it is, let's say, is higher, let's say 12%. Okay. But the SD, the standard deviation of volatility of that year is 15%. Okay, KPLC, the volatility is, let's say, since its ER is higher, expected return or 12 is higher, so their SD will also be Standard deviation is volatility. Volatility is, let's say, 20%. Okay. Therefore, and we see the correlation coefficient. Now, this is what we will be using to calculate the expected return of that portfolio over that portfolio, that mix of two portfolios. Okay. So now the correlation coefficient let's say is 0.5. 0.5. Okay. Therefore, so now the formula for getting the portfolio expected return, so expected return is basically the correlation coefficient times the expected return of each. Okay, and then you sum them up. For example, so it will be 0.5 times 10 plus 0.5 times 12. I don't know if you're getting it. The correlation coefficient times the expected return of each. That's how you get the expected return of that portfolio. Obviously, that I hope that makes sense to you. Okay, so it's the correlation coefficient times ER of each. Just a minute. Of each. Just a minute, somebody's calling me. Sorry about this. Okay. So you said to get the, so now this one, the expected return of that portfolio, is the correlation coefficient times the area. And how are they related? So what's the correlation coefficient of those two? Expected return of those two. So in this case, it will be 0.5 times this, put the sign of sum. Even does it look? Is there even the sign of sum? I don't think so. But you know how the sign of sum looks like something sum. Oh. So it's 0.5 times, for example, the year of Safaricom was 10 times 10%. Okay. Plus still 0.5 times 12%. Still. If we do that, that would come to basically half of 10% and half of 6% of 12. So that's half of 0.5 cent. So 5% plus 6%. So that's 11%. Okay. So that's the rate of return or the expected return of that portfolio. That's how we get it. It's basically that is okay. We get the sum of the coefficient relation or correlation coefficient of each and then sum them up times the expected return of each asset. Okay. And I hope you know how to calculate the even SD, standard deviation. It's the same too. You just multiply the coefficient of correlation times the, for example, the standard deviation of each to get the standard deviation of a portfolio. And to get either the standard deviation of a portfolio or the expected return of a portfolio is just the coefficient of relation times the standard deviation or the expected return of each asset. That's how you get now the standard deviation and also the expected return of that whole portfolio or that whole mix. Okay. I don't know how, if you are understanding me. Let's say you have two things that are related, okay? Now to get, now this, I don't know how to explain it. Let's say you have, I'm thinking of something that will explain this better, okay? But basically, let's say you have two assets, okay? If I invest in this bank, okay, my expected return, okay, let's say you have the possibility of investing, of putting your money in either a money market fund or let's say buying a bond, okay? If you buy a bond, you'll get 15%. If you put it in a money market fund, you'll get 13%. And the coefficient of correlation of between investing in a bond or a money market, okay, is, let's say, 1%. So to now get the coefficient, or to get the expected return of that portfolio, if you invest in each of that portfolio of that mix, okay, is now the coefficient of relation times the expected return or the rate of interest of each form of investment. Okay, I hope now you can understand. Similarly, to get, for example, the SD, okay, or the volatility, okay, or the risk, okay, the risk of each is also of that whole mix is also the risk of each times the coefficient of relation. And then you sum them up in each case, okay? Let's proceed. Let's now look at asset allocation and diversification present. Just as there is in addition to the modern portfolio theory of the risk and versus reward, then let's now look at the asset allocation. Asset allocation is basically how you divide an investment portfolio, okay? If you have a portfolio of assets, okay? If you are to invest in, let's say, a portfolio of assets such as you have stocks, you can also invest in bonds, you can also invest in other forms of investment. So how you will be able to invest in each, how you will be able to apportion or to divide that investment portfolio among the different types of investments or investment classes, okay? Then that's what we call asset allocation. But diversification, on the other hand, is basically a risk management strategy where you don't want to put all your eggs in one basket. You don't want to invest in only one form of investments. You want to spread them over a variety of investments or a variety of assets. So since when you hold, by holding, for example, a variety of assets, that especially the keyword here is a variety of assets. They don't need to be related or assets that are correlated, okay, by either their expected return or their volatility or any other factor, okay? Therefore, you will have reduced your risk. I mean, should there be a risk, okay, in one, for example, or therefore you will be hedged against also losing in the other forms of investments or assets that you also invested in. So let's give let me think of an example to drive the point home a bit better. Let's say you have a portfolio. Let's say you're investing in Safaricom shares, okay? And you also can invest in the shares of maybe another company, maybe Kenya Power. You can also buy a little bit of the Kenyan Treasury bonds, okay? Therefore, to know how now what the, for example, the expected return of each portfolio, it will be the coefficient of correlation times the, just as we said, the coefficient of correlation times the expected return of each asset class, okay, of each, even of investing in Safaricom, of investing in Kenya Power, or investing in the Kenyan Treasury bonds, okay? That's how you'll get the expected return of investing in that whole portfolio, okay? Similar to the SD, getting the standard deviation of, or the risk of that investing in that whole portfolio of stocks of both Safaricom and Kenya Power, and also in Kenyan Treasury bond, okay? So we know, as I've just mentioned, that diversification is a risk management strategy, so that you reduce the risk of for example, an asset decline. For example, the overall risk, when you add different sorts of asset classes into your portfolio, the overall risk will be reduced. So at a particular, you will find that at a particular rate of return, when you diversify, the risk will reduce, okay? Then let's move on to active versus passive portfolio management. Active portfolio management is basically where, for example, as an investor, you make decisions on whether to buy or to sell based on purely analyzing the markets, and you just attempt to, for example, to see how to outmaneuver the market. That's I think I even alluded to this a little bit earlier in our lesson. I say you can also either be an active investor or a passive investor. An active investor is where you actively analyze even the market return, market data, okay, market returns of the different companies and different investments, and then you see how to diversify and even how to outdo or outmaneuver the market, okay? Whereas when you are a passive investor or a passive portfolio management, is where you invest, for example, in a secondary fund that basically is related to the main or active portfolio that you want to invest in. For example, if you invest in a stock market, okay, or let's say you invest in a market index, then therefore you will be a passive investor, as opposed to when you actively analyze, for example, the market returns, or for example, the disclosures of the different companies that are listed and are trading at the actual stock exchange. So investing in a secondary market, that's passive investments or passive portfolio management, while actively investing, that's called active portfolio management. Let's continue. So we have talked about how the modern portfolio theory emphasizes that you need to balance risk and return through efficient portfolio. I've talked about how we can calculate an efficient portfolio by getting the coefficient of correlation, summing them up times the expected return of each, okay? And also by optimizing the Sharpe ratio for maximum reward at a given level of risk. And then we've also talked about asset allocation and diversification. We have talked about that. We have talked about active and passive portfolio management. Let's now look at portfolio rebalancing and tactical asset allocation. Okay. Portfolio rebalancing. I was just taking another trainer in a similar course just the other day, where we were rebalancing our ALM strategy, especially in bank treasury management, okay? So it's just similar to that, okay? Portfolio rebalancing, it's basically adjusting or rebalancing or readjusting your portfolio mix, okay? Especially to achieve a desired asset or asset allocation. Okay, you find that over the time of an investment, for example, if you hold a portfolio of, let's say, 50% bonds, 30% stocks, okay, and then periodically, according to the, for example, the expected returns of each and the performance of each, you might need to rebalance, okay, you are holding in each kind of asset and also portfolio. While tactical asset allocation basically involves making short-term adjustments to the portfolio based on, for example, the prevailing market conditions. Okay, you allocate assets tactically according to the prevailing market conditions. Let's say you want to rebalance a portfolio of stocks and bonds to maintain, let's say, a ratio of, let's say, 3 to 2. Okay, for every 3 units of assets or 3% of assets that you hold, then you'll hold 2%. Okay, let's say you have a portfolio of 100,000. Therefore, you will hold 3 to 2. That you will hold 60%. 60% of that 100,000. So 60,000. Okay, and then 40,000. And let's say you want to hold them in bonds and stocks respectively. So I just wanted us to do, for example, to just to drive the point home, I wanted us to look at an example of what I'm trying to say. So let's say you have, I'm opening my notes. If you open the notes, you can see it. Okay. Okay. So let's, right. So rebalancing, portfolio rebalancing, and protective asset allocation, portfolio rebalancing. Okay. So let's say you want to achieve, okay, you already hold a ratio of 3 to 2. Okay. So ratio of your portfolio, portfolio, let's say it's 3 to 2. Okay, and let's say your total portfolio is worth, let's say 100,000 Kenya shillings. 100,000 Kenya shillings. Okay. Therefore, what this means is 3 over 5 of 100,000 and then 2 over 5 of 100,000, right? That comes to 3 over 5. That's 300,000 divided by 5. That's 60,000. So let's say, okay, 3 of ratio of portfolio of let's say stocks to bonds. Somebody keeps calling me while I keep declining their calls. Can they take that as a cue? Okay. Okay. So you have your total portfolio is worth 100,000, and the ratio of the stock holdings and the bonds holdings that you hold is 3 to 2. Therefore, that means that stocks you hold 3 over 5, 3 plus 2, 3 over 5 times 100,000. That's 300 divided by 5. That's 60,000, right? And therefore, the remaining 40,000, it remains 40,000, which is bonds. Okay. Therefore, so now I want us to do a scenario analysis where, let's say you need to rebalance, okay? Let's say, for example, after a year, your stocks have increased by 10% and your bonds have increased by, let's say, 5%. Therefore, that means that, let's say, when stocks increase by 10%, so that's now 110%, right? So 110, to get the new value, it's 110 over 100 divided by 100 times the original 60,000. Just a minute, I want to also join from the computer, so I'm able to present better. I want to be able to present while I also type here on the notes so that you can see what I'm trying to say. Okay. All right, so let's see. Therefore, okay, so we also needed that, we also said that, let's say also after a year, okay, the value of your holdings in stocks increased by 10%, or let's say bonds are also increased by maybe half, so 5%. Just okay, mute tab. So therefore, that this comes to 66,000, right? It's 11 times 6, so 66,000. And therefore, let's say also 5%, and also let's say after the year, bonds also increased by 5%, so that's now 1 of 5. Okay, 1 of 5 over 100 times 40,000. It was 40,000. That comes to 5 times 4. 1 of 5 times 4, that's 108. That comes to 42, right? 42,000. 42,000 stocks bonds after 5% increase. Okay. Therefore, you initially held 100,000. Therefore, you now hold 66 plus 42. That comes to 110 or 108, right? So total new portfolio is 66 plus 42. That's 108,000. Okay. But then you need to rebalance. Okay. Okay. Let's say you are efficient, maybe portfolio theory. Okay. Or your portfolio allocation, asset allocation theory, you wanted to maintain a ratio of 3 to 2. You remember? A 3 to 2, therefore, of stocks to bonds. Okay, therefore you'll need to rebalance this in this way. You also need to do a 3 to 2 ratio. So now 3 over 5 times 108. So, but your ratio need to be 3 to 2. Okay. I'm just using just arbitrary values so that you understand what I'm trying to say. Since this is because the rate of increase, okay, or the rate, the 5%, the 10%, they increased not similarly, okay? They increased differently. So therefore, you'll need to do a balancing, okay? need to be 3 to 2. Therefore, so now your new stocks needs to be 3/5 times 108, the new total. Okay, which comes to 64,800. New bonds need to be 2/5 times 108,000. Just a minute. This comes to 43,200. Just a minute. Calculator. So 3/5 divided by 5. What the hell? Times then so 2/5, that came to 64,800. Therefore 2/5 times still 108, 1, 2, 3, 43,200. Therefore, you see, so here is what I'm trying to do to arrive. Is the point I'm trying to make. Since what you hold was you held 60,000 in stocks and 40,000 in bonds, but your new stocks are 64,800, and your new bonds are 43,200. Then therefore, what will you need to do? You will need to, for example, okay. I hope you have gotten what I'm trying to say, right? So what I'm trying to say is, I was just following on my calculations if they're correct, and yeah, they're correct. 2/5. But your new, you remember your new holding of stock was 66,000. You remember 66,000. But you need it to be at 64,000, the new ratio. You need it to be at 64,800. Okay. Therefore, what will you do? Okay. You hold stocks of 66,000, but you need it to be at 64,800. Therefore, you'll need to sell the extra. Okay. You need to sell the extra. Let me just type what your stocks are at 66,000, but you need it to be at 64,800. Therefore, you have an excess of how much? 66 minus 12, right? 1,200. So you hold an excess of 1,200. Therefore, what can you do? You can sell the 1,200, right? So now that will be your portfolio rebalancing strategy. Similarly, in bonds, you needed them to be at 64, no. Bonds are 43,200. No, how much did you hold, first of all? You hold bonds worth 42,000. They were 42,000. That's what you held after the increase, okay? But you need them to be, as per our portfolio management strategy, we need them to be at 43,200. You remember? 43,200. So, meaning we don't have an excess, we have a deficit, okay? We only hold 42,000, but according to our ratio, it should be 43,200. Therefore, 43 minus 42, that's 1,200. So you need to buy bonds of 1,200 while you need to sell stock of 1,200. So that will be your portfolio rebalancing strategy. I hope you have understood up to there. Let me just type. So bonds, on the other hand, are at 42,000, but you need them to be at 43,000. So you have a 1,200 deficit. So buy the 1,200. That will be your portfolio rebalancing strategy. Is that okay? I hope you have understood up to that point. Let's take a short break, like a 5-minute break, as I answer some call here, please. Even just a 2-minute break. we are going to suffer as an investment firm, as a stock exchange, or as a fund management company, things like that. Okay. Also, as I said, bonds also suffer. I mean, carry with them a lot of interest rate risk that is very very high. Since when, for example, rates in the economy rises, we find that the prices of bonds will fall, and therefore credit risk can be associated with the bond prices, and also, for example, the rates of bonds. Okay. And even in the other forms of investments in the capital markets, things like rates, okay, real estate investments, that can also even be affected by things like liquidity risks. Okay. Let's say you want to liquidate your, for example, your holdings in rates. Okay. You may not be easily be able to liquidate them, and therefore that can also lead to liquidity risk. Okay. Then therefore, since we've looked at now the different types of risks that are associated with the investment in capital markets, then what can an investor, what options lie within the behest of an investor to be able to hedge themselves against or mitigate themselves against such market risk, credit risk, liquidity risk, operational risk, and interest rate risk. Okay. So it's basically now hedging or risk mitigation is how we try as investors to be able to reduce the risk that we are exposed to in our portfolios or in our holdings. Okay. So derivatives, we talked about them a lot. Okay. We have options, we have futures. Okay. Which themselves can also be instruments, financial instruments for investments. Just a minute. Sorry about that. Sorry about that. So, yeah, themselves, the hedging strategies can also be financial instruments for investment. So, let's look at, for example, futures. We have talked a lot about this. Futures are basically an agreement or a contract between two parties where you agree, for example, to buy or sell a bond or an asset that you hold, or a stock that at a particular price or at a particular rate in the future at a predetermined price or rate. Okay. For example, you as an investor, you may use a future, okay, to hedge yourself against the rising prices of bonds or rising prices of, for example, commodities such as gold or oil. Okay. Similarly, you can also use options. Options were a little bit similar to futures in that they will give you the right but not the obligation to buy at a certain price should the price or should the risks, okay, that you're trying to hedge against move or fluctuate past a certain price or rate. Okay. For example, you when you have the option to sell, when you buy an asset at let's say, or you buy a bond at when it's 2000. Okay. Should the bond price or should the rate, for example, of the bond move below, let's say, 1800, you can either agree to sell it at 2000 that you bought in, or even lower. Okay. So you have that right, but not the obligations. Okay. Should they even move past another past a certain price that is agreed upon, okay, in prior, then you have the right or obligation to sell it, or even to buy. For example, now it depends whether when you want to sell the assets, now it will be a put option, and then vice versa, it will be a call option. Similarly, we can also even use swaps, okay, as another form of hedging strategy. Okay. You'll, for example, let's say, agree to pay, for example, the bond the prices of a bond or the coupons, okay, the cash flows, for example, for the payments, okay, from the bonds that you hold, for example, okay, or any other asset that you hold for another, okay. Especially, let's say you also have some holdings, for example, in forex and also interest rate, even the interest rates and currencies that carry with them forex and currency risk. Therefore, you can use swaps in this case. For example, instead of paying, for example, the cash flows in one currency, you pay them in another currency. So you can do an interest rate swap or a currency swap in that case to hedge yourself against the interest rate fluctuations and currency volatility. Then therefore, let's look at value at risk, VAR, portfolio VAR especially. So we are here. So portfolio VAR, it's the measurement of for example, the portion of our portfolio that how much risk is it exposed to, okay? It's basically a technique or a measure the potential loss or the exposure that our portfolio over let's say maybe a 30-day period over a year, okay, for example, but it's usually at a given confidence level, okay. So let's say, for example, I was just teaching this very concept the other day. Let's say you hold you as a bank or an investment bank, okay, you are holding 2 million euros, okay. All right. You are holding 2 million euros because you are confident, for example, that the euro will appreciate, okay, against, let's say, the USD. Okay, that's why you are holding so much of it in anticipation or at a confidence level of, let's say, 90%. Okay, that you are confident that the euro will appreciate against the USD, therefore you will gain. Okay, so the portfolio at risk is the compounding measure of the portfolio that you hold. For example, the 2 million euros that you hold at the particular confidence level, compounded by the risk factor. That is the realized volatility or past volatility. That's where past volatility matters a lot. For example, the past standard deviation or the past volatility of the euro against the USD in this case. So let's say the past volatility rate, the rate of standard deviation of the euro against the USD, let's say it's 5%. Okay, and therefore, let's say your confidence level is 90%. Okay, then therefore in that case, the portfolio. In fact, I think I can type where not. Can I type here? I wanted to show you how I can. It seems I can't. I'm not able to open my notes, but I can just explain to you what I mean by that. Should So now in that case, your portfolio value, your portfolio value at risk will be the position or the amount of currency that you hold, okay, and for which you face interest rate risk, okay, times the interest rate risk volatility at the confidence level, okay. So in this case, it will be 2 million that you hold in euros, okay, the volatility of the euro against the USD, let's say in the past it's been 5%, so that's 0.05 times the confidence level. We said you were 90% confident, so the confidence level is 10. So the risk is the remaining 10%. Okay, you are 90% confident, so the risk is 10%. So 10%. Okay, so 0.1, right? So that will be the portfolio VAR. 2 million times 0.05 times 10. That comes to just a minute. So 2 million times 0.05 times 0.1. So your portfolio at risk, your portfolio VAR is now 10,000. Okay. So that's now how simply we can trade the portfolio VAR. Okay. Therefore, what that basically means at the 90% confidence level that you have, that you will gain from the euro depreciating again, I mean appreciating against the USD, but due to interest rate risk that is not assured. Therefore, the past volatility, let's say, is 5%. Okay, then therefore at the 90% confidence level, your portfolio, the value of your portfolio, the value of the 2 million portfolio that you have that is at risk is only 10,000. Okay, so it's like you are confident you won't lose. You are 95 confident that you won't lose more than 10,000. It's basically in other words, it's to say that you are 10% confident or 90% confident that you won't lose more than 10,000 shillings. Okay, because that's your portfolio value at risk. But it's important to mention that portfolio at risk also is also time dependent. Okay, you can only calculate it over maybe let's say even a day period or even a week period, or mostly even a month period. Over, so it's like over the past 1 month, the portfolio VAR has been, let's say 5%, or the volatility has been 5%. So over the next 30 also 30 days, then you are confident your 1 day, your 30-day VAR will be 10,000. Okay, that confidence level is usually on a scale. It's usually called Z score. The Z score, basically the confidence level on a scale. Okay, so it estimates the maximum potential loss of a given time frame at a specific confidence level. So in this case, the maximum potential loss is 10,000 over, let's say it was a 30-day period at the 90% confidence level. Okay. Next, let's look at now stress testing and scenario analysis, especially for risk mitigation. Okay. Oh, yes. So, yes. So now let's look at stress testing and scenario analysis. Stress testing and scenario analysis basically it involves simulating the worst possible, for example, or extreme scenarios, and then being able to position yourself or put in place risk mitigation measures to ensure that your portfolio can handle or can absorb that much stress or that much extreme scenario. Okay, it's basically measures how strong your portfolio is to withstand, for example, the different types of risk that we saw. For example, it can be historical stress testing, where you, for example, simulate the any past worst scenarios. Okay, so in this case, you can estimate the resilience or the strength of your portfolio to withstand, for example, financial risk by simulating a worst case scenario, e.g., the 2008 financial crisis. Okay, let's say you can simulate that during the 2008 financial crisis, interest rates rose maybe as high as 20%. Okay. Were you able to survive? If you weren't, okay, what measures or what risk, especially specifically, what risk mitigation measures can you put in place to ensure that should such a, for example, a past worst case scenario occur again, and then will your portfolio be able to withstand or handle or absorb the losses and the risk that come with that? Okay, and it can also even be just an hypothetical simulation. Okay, you hypothetically simulate a worst case scenario. Okay, maybe based on, for example, you hypothesize let's say interest rate risks and for example maybe political tensions in the country, and then what will for example such interest rates hikes in the country due to, for example, the assets and the capital markets and the bond prices in the country. Okay, things like that. Okay, for example, you can simulate, or you can try to imagine or hypothesize that let's say in the stock market there is a 10% drop in the stock market prices. Okay, and let's say even the interest rates increase by, let's say, 10%, then therefore how will that affect your, for example, your asset and liability holdings and your generally your portfolio. Okay, you hold maybe stocks and bonds. Okay, the stock prices, let's say they drop, let's say you hypothesize 10%. Okay, bond prices, coupon rates, they, let's say, increase by 5%. Okay, stock prices drop by 10, bond prices they increase by 10. Then what will that do, for example, to the guy that had a 3 to 2 ratio of holding of 100,000 portfolio? Okay, what will that do to him? Okay, you see how we were able to do the scenario analysis then. Okay, even that was exactly what we did, was now the scenario analysis, and therefore we saw what he now needed to do. He now needed to diversify and rebalance his portfolio. Okay, he needed to sell 1200 and also buy 1200 bonds to be able to maintain his own original rebalance or balance of portfolio. Okay, you can also even try to estimate, for example, so now you can do a stress test to hypothesize what your maximum loss from, for example, such an interest rate hike and also bond prices decline will do to your portfolio. Let me just try to present something to you so that you know exactly what I'm talking about, how you would in that case do that. So let's say you have a portfolio of, let's say, still 3 to 2. Okay, and let's say you the portfolio is you have a portfolio of a million at a ratio of 3 to 2, 3 stocks to 2 bonds. Okay, so now we want to hypothesize a stress test or stress test a scenario where there is the stock market prices drops or declines by 10%, and the interest rate markets or the bonds rises by, let's say, even 1%. What will that do to your, for example, what will your total loss or maximum possible loss be in that case? Let me try to share, because I'm trying to, I think I can even do this. How is it? Okay. So in that case, so the stock portion, it was a ratio of 3 to 2. Therefore, 3/5 of 1 million. How much is that? Let's be able to type here. Okay. Portfolio. Portfolio is 1 million Kenya shillings. Okay. Ratio of stocks to bonds in your portfolio. Is 3 to 2. Okay, therefore that means that stocks are 3/5 times 1 million. That comes to 3/5 times 1 million. That's 0.5. 0.6, right? 3/5 times 1 million. That's 600,000. Oh my even. This age of calculators and phones, even some sum that you can easily do on your head, you quickly find yourself having pulled out your calculator. And therefore, obviously, now the bonds are the remaining 400, right? $400 to 3. Okay. But so we are doing a stress test. Okay, let's assume that the bond price or the stock prices in the economy or in the capital market decline by 10%. What that means is that there is a 10% drop. So 10% of 60 of 600. Therefore, a 10% drop means that you will lose 10% of the 600. So that now that's 660. I mean, right? So simulate a worst case of 10% drop in the stock market prices and 5% interest rates. Therefore, 10% of drop in the stock market prices means 10% of your holding of stocks. That's 600,000. Therefore, uh, your holding, your portfolio of stock will decrease by 10% of 600. That's 60,000. So your loss
loss in stocks, maximum loss in stock due to the 10% drop in prices will be 10% of 600. $600,000, which equals 60,000, right? So in this case, you'll only leave 60,000 in stock, and then loss in bonds in your bond holding will be 5% of the 400,000. That comes to 20 divided by 100, so now that's 20,000, right? So your total loss from that worst case scenario will be 60,000 in stock and 20,000 in bonds, coming to a total of 80,000 in your total portfolio. 80,000 loss in your total portfolio. So now, as an investor, okay, you'll be able to see, is your portfolio strong enough to be able to absorb this 80,000 loss? Okay. So now that's how you as an investor can be able to do that stress test and simulate a worst case scenario. Or in this case, we simulated that the interest rate prices rise by 5% and the stock prices decrease by 10%. Okay, let's move on. So I hope we've been able to now identify, we've been able to talk about, for example, the different types of risk that are associated with the capital markets, from market risk to interest rate risk. All the other types of risk, we've been able to see, for example, how to use the different hedging strategies to be able to hedge ourselves and mitigate ourselves against those risks. We've also seen, for example, how to use those derivatives. We've been able to, for example, we saw how to calculate a typical value at risk. We have been able to even conduct a stress test of simulating a worst case scenario where stock market prices decline by 10% and interest rate rise by 5%, and we are able to see, will you be able to take a 20? Was it an 80,000 Kenya shillings loss in your 100,000 portfolio? Okay, so it's very, very important for us to be able to analyze all that, to be able to manage, for example, and put in place good and proper risk mitigation and management strategies to ensure that the portfolio that we hold can be able to withstand the various risks that we talked about. Okay, so that about brings us to the end of module 6, right? So tomorrow we'll begin on module 7, and we'll talk about now the other types of investments and diversification strategies For example, the other rates we are, we talked about, touched on that a little bit, but now tomorrow we'll be looking at them in greater detail, and now see, for example, what are the different alternative investment strategies and also avenues that we can invest in capital markets. Okay, can even be looking at commodities like gold, even, and oil. Okay, and even agricultural produce. Okay, and we'll be looking at a little bit of emerging and modern concepts in investment, such as the blockchain technology, cryptocurrencies, things like that. Okay, so yes, that brings us to the end of today's modules. Unless you have any question, please. Otherwise, see you tomorrow, same time, same place, as we finalize on module 7 and 8, and then we finalize everything with module 9 and a recap on Wednesday.
Okay, so I'll see you tomorrow.
Okay, thank you so much, and have a good night, good evening. Should you have any issue, we can always talk anytime. Thank you very much, sir.